Boohoo Stock has had some bad years since its peak in 2020, falling by over 93%. More recently, a trading update saw serious sales issues in the company, and it raises the question, is Boohoo a huge opportunity or is it going bust? In the last 5 years, Boohoo has seen its revenue double. They saw huge benefits in the pandemic lockdowns, with many high street retailers forced to close. At the time, people just didn't know what to do with all the extra furlough money, and so they bought plenty of cheap clothing. However, more recently, earnings have fallen from positive to negative, competition has increased, and the management have made some questionable decisions. Could this be the perfect storm to buy shares? Well, free cash flow paints a slightly rosier picture, with it remaining positive but falling by 17% since 2019. That said, investors clearly aren't as interested, as market capitalization in this same time has fallen by 69%. Obviously, in 2023 the business is unprofitable, but it's important to see that during 2019 to 2021 they maintained a ROIC of above 20%, which is good. During that same time, Boohoo had minimal debt on the balance sheet, which meant that that number is relatively organic. That said, their debt to equity ratio has increased from 2.6% in 2019 to 115.9% in 2023, showing a significant decrease in the quality of the balance sheet. This has been primarily driven by taking on more debt, which has increased from 7.2 million to 464 million in 2023. Equity has also fallen by 15% the last 2 years, driving this ratio upwards. Whilst the cash position of £331 million is the highest level of the last 5 years, the increase in debt has led to the net position falling by 43%, meaning investors who held shares of Boohoo 5 years ago have actually seen a reduction in the book value. On the other hand, the current and quick ratios are above 1, meaning the company is financially resilient and can pay off its liabilities in the short term. As you'd expect, this has worsened in the last 5 years, but the current balance sheet is unlikely to go bust. So given the concerning sales but strong financial position, could this be a value opportunity for a turnaround company? When looking at relative valuation, we can see that Boohoo is valued at 8 times its free cash flow in 2023, which is very close to its 52-week low and half that of its high. Historically, Boohoo has averaged a price to free cash flow of around 25.8 times, which might indicate that if shares recover to their former glory, that this could be a good current value. Given the shaky financials, I'd be more interested to look at the book value of Boohoo. Currently, it's valued at 0.9 times its book value, meaning if you bought shares right now, you'd be buying at less than the asset value, but only if the balance sheet doesn't get worse with continued unprofitability. When comparing to the UK market average, the price to sales ratio would suggest that Boohoo is undervalued at 0.2 times. That said, Boohoo at its peak only had net profit margins of 5.2%, meaning that the price to sales ratio is definitely a secondary factor. Thus, I would take this with a grain of salt, as investors focus primarily on earnings growth. Boohoo appears to be a good value opportunity. However, it's important that we look at the recent results to identify if it's time to buy or sell. Half-year figures paint a much gloomier picture. Revenue has continued to decline, falling 17% year on year and 25% on a 2-year basis. Free cash flow has remained negative in the first half, but has accelerated since last year. Profits show a continually declining picture that's gone from positive to negative and shows no signs of slowing down. That said, given the current balance sheet and assuming that losses start to level in the short term, they have plenty of cash runway and can continue operations. There's no immediate risk in the next 12 months of Boohoo going bust. However, the net position on the balance sheet has continued to fall, with cash falling by 8% and equity falling by 11% year on year. This is a big concern. The underlying book value of Boohoo is falling, and it's justifying the share price movements. In fact, the net position has fallen by 38% in the last year, and share price has fallen by 18% in that same time, suggesting that shares might even have more room to fall if not already priced in. Investors seeking deep value might look fondly upon Boohoo at its current valuation, but without a substantial turnaround in momentum and profits, this could continue to be a falling knife. So given that I hold a substantial position in Boohoo, what do I think of the situation, and more importantly, what am I going to do with my shares? Well, it's important to assess the original reasons for owning a stock. I bought Boohoo Boohoo for growth, believing that they are dominant in their industry. However, I've come to realise that whilst they are dominant, the industry has very low barriers to entry, meaning there's always room for a bigger fish. They also don't have that sticky factor that makes their products unique to others aside from a low price. Don't get me wrong, a volumes-based business can dominate the industry. Just look at the rise of JD Wetherspoon. That said, it's a lot trickier to establish a low-price business in the hospitality business as compared to simply setting up an online clothing store. And that's not even getting into the quality of the products comparing the two businesses. I do think that the problems that Boohoo currently face are shared by other retailers in the industry. Boohoo has not uniquely suffered, and the trend has also followed the likes of ASOS. The real question is whether online clothes retailing is really the niche to be invested in. I bought shares at a ridiculous valuation, aka a 50 times price to earnings ratio, and it's almost comical in hindsight. There's no point trying to regret my investment or wish I'd done things differently, as quite frankly it doesn't change the current situation at hand. I have 21,816 shares at an average share price of £1.20 each, which means that shares would have to quadruple at the current price of 29 pence a share just to break even on this position. I'm reminded of a book, The Art of Execution, in which the author categorized some investors as rabbits. This is a mocking but fitting name. He continues on to suggest that people who anchor onto their investments and be unwilling to accept new findings are rabbits. These rabbits underperform because they made the active decision to do nothing after a significant loss. Therefore, I'm left with two choices: buy significantly more and average down, or cut my huge losses and invest elsewhere. And so I ask myself this one thing: if I had the cash that is currently invested in shares of Boohoo, would I buy shares of Boohoo with that cash? Before I answer this, I should also consider the impact of averaging down. In order to save my position, I would have to invest an additional £8,000 to lower my average to 69 pence. This still requires a gain of 138% from 29 pence a share to break even. And given my current position is only valued at £6,500, this would push it to be the biggest stock in my portfolio again, and the quality of the fundamentals might not justify this. So what have I done with my holding in Boohoo? Those of you that have live access to my portfolio have known for a few days. I sold 11,816 shares for a price of 29 pence each and have reinvested it immediately into a new stock. Live access is completely free, and you can see exactly what stock I bought by clicking the link in the description down below. Is Lloyd stock a value trap? Well, click here to find out.